You are 52. You have 18 years left on your mortgage. And every weekend when you sit down with your coffee and look at the balance, your gut tells you the same thing. Throw extra cash at it, pay it down faster, get free. If you are a high earner staring at that balance, I keep seeing the same instinct, and I get it. Debt-free feels safe, adult, responsible. But there is one number you have probably never calculated. And it is the number that decides whether your instinct is right or whether it is quietly costing you a fortune. Here's the thing nobody told you. 2 tax rules just changed in January 2026. Most people I talk to have not recalculated, and the change widened the gap in a direction that almost everyone gets wrong. Let me show you the number first. Then I will show you the rules. Picture this. You decide to throw $500 a month at your mortgage principal for the next 25 years. Feels good. Feels disciplined. Now picture the same $500 a month invested instead in a diversified portfolio earning 8% a year, compounded monthly. Over 25 years, that becomes about $474,312. That is what mathematicians call a future value calculation, not a prediction, a calculation. And it is what you are giving up in expected value terms every single time you write that extra principal check. Now, is 8% guaranteed? No, of course not. The S&P just returned 25.02% in 2024 and 17.88% in 2025, and the long-run average sits somewhere around 10 to 11.5%. Some years are great, some years are terrible. That is the whole point of why this is a real decision. Here's the claim, plain and simple. If you are a high earner with a long horizon, an itemizable mortgage, and the discipline to actually invest the difference, paying off early loses to a diversified investment alternative on an after-tax basis. And the 2026 tax changes just widen that gap. That is the thesis. Now let me show you why. Pull your amortization schedule, I mean it. Open it up. Here is what most people never look at. On a $500,000 mortgage at 6.5% on a 30-year fixed, your monthly payment is $3,160.34. Sounds reasonable, but in the first 10 years, you pay roughly $313,652 in interest alone. That is not a typo. $313,000 to the bank. Why so much? Because amortization front-loads interest. In the early years of any 30-year mortgage, the overwhelming majority of each payment is interest, not principal. It is not a bug. It is just how the math is built. So when you throw an extra payment at the principal in year 3, you are fighting a different battle than when you throw it in year 23. That is brutal arithmetic. And it is the reason the early payoff instinct feels so right. You see the interest column and you want to kill it. I get it. But here is the move smart money makes. They do not look at the nominal mortgage rate. They look at the after-tax rate. Because every dollar of interest you pay, if you itemize, comes back to you partially as a deduction. So your 6.5% mortgage might actually be costing you closer to 4.5% in real terms. Now compare 4.5% to a long-run market average above 10. Different conversation, right? And by the way, the investing side has a tax cost too. Long-term capital gains for high earners are taxed at 20% federal plus 3.8% net investment income tax. That is 23.8% federal on gains in a taxable account. So no, the comparison is not free money. It is after-tax mortgage rate versus after-tax expected return. Yes, this is the part of the video where you should be writing things down. So here is the question that should be pulling you forward. If the after-tax math already favors investing, why did the rules just change in a way that makes the gap even wider? January 1st, 2026. 2 things shifted, and almost nobody has recalculated. Number 1, the SALT deduction cap. From 2018 through 2025, the state and local tax deduction was capped at $10,000 per return. That cap pushed millions of high earners into the standard deduction. Itemizing was just not worth it. In 2026, that cap jumped to $40,400 for most filers, $20,200 for married filing separately, with 1% annual bumps through 2029, then a scheduled reversion back to $10,000 in 2030. Read that again, $40,400. If you live in a high-tax state, California, New York, New Jersey, Massachusetts, Illinois, your state and local taxes alone may now eat that whole new cap. Add in your mortgage interest, your charitable giving, your other deductions. You are now well over the standard deduction threshold. You are itemizing again. The mortgage interest deduction matters again. Number 2, the mortgage interest deduction limit itself. From 2018 through 2025, married couples filing jointly could deduct interest on up to $750,000 of home acquisition debt. After 2025, that limit reverted. Now you can deduct interest on up to $1 million of acquisition debt per tax foundation. That is $250,000 more of mortgage that just became deductible. You might be thinking, fine, but did not the higher standard deduction kill itemizing for most people anyway? That is true historically, and it is the reason millions of homeowners stopped getting any tax benefit from their mortgage. But 2026 is the reset. The higher SALT cap is the door reopening. If you ran your Schedule A in 2024 and concluded the deduction was not worth chasing, you owe yourself a fresh look with 2026 numbers. And here is the sequencing piece almost everyone skips. Before you direct $1 extra at mortgage principal, max your tax-advantaged accounts. In 2026, if you are 50 or older, the catch-up contributions are bigger than they have ever been, plus an HSA if you qualify, plus an IRA. These accounts shrink your taxable income now or grow tax-free for life. The math almost always favors filling those buckets first. Most high earners flip the order and lose ground every year. Quick tee-up. None of this means early payoff is wrong for everyone. There is a real case for it. And I want to make that case honestly, because if you only hear one side, I have not actually helped you decide. So here is the Steelman case for paying off early. Sequence of returns risk. This is the most underrated objection in personal finance. Imagine you retire in 2028. Markets crash 25% in your first year. You are still carrying a mortgage. To make the payment, you have to sell investments at the bottom. You lock in the loss. Your portfolio never fully recovers because you withdrew the most when prices were the lowest. Same average return as your neighbor, half the ending balance. That is a real risk. And the closer you are to retirement, the bigger it gets. Liquidity is the second one. Home equity is illiquid. You cannot pay your grocery bill with bricks. If you are within 5 years of retirement and you have not built a 2-year cash buffer, the case for accelerating payoff actually strengthens. Because the guaranteed return, 6.46% on the May 5, 2026 average 30-year fixed, 6.30% the week ending May 1st per Freddie Mac, is genuinely competitive with the after-tax return on a Treasury portfolio yielding 4.39% on the 10-year as of May 1st. The numbers got close. They were not close at 3%. They are close now. A friend pushed back on this exact point with me last month. His argument: the Ramsey solutions. Everyday Millionaires study looked at over 10,000 millionaires. 89% of them did not inherit their wealth. They built it through consistent investing, saving, and living below their means. Discipline, not arbitrage. So if I am being honest about whether I will actually invest the difference, or whether that money will quietly get absorbed into a nicer car and a kitchen renovation, maybe the guaranteed return of mortgage payoff is the more honest answer for me. He was not wrong. That self-knowledge matters more than the spreadsheet. And peace of mind is real. If your mortgage is keeping you up at night, that anxiety has a cost too. You are allowed to value sleep. There is one more wrinkle that quietly cuts the other way: inflation. Your fixed-rate mortgage payment stays constant in nominal dollars, but those dollars are worth less every year. Average annual CPI inflation over the 10 years through March 2026 was about 3%. Over the 20-year period, about 2.6%. So your mortgage is being paid down by inflation automatically while you sleep. The catch: inflation also erodes the purchasing power of your savings. So this is a relative advantage, not a free lunch. Still, every year you carry the mortgage, the real burden shrinks a little. Edge case worth flagging. If you have already maxed every tax-advantaged account, you have a fully funded cash buffer, you are within 5 years of retirement, and you do not itemize because your SALT plus mortgage interest still falls below the standard deduction. The math flips. For that specific person, paying off the mortgage is probably the right call. The framework is not a permission slip. It is a test. Okay, so how do you actually decide? 5 questions. Run them against your numbers. Not generic benchmarks, yours. 1. What is your actual after-tax mortgage rate, not the nominal rate? If you itemize, multiply your mortgage rate by 1 minus your marginal tax bracket. That is the number you compare investments against. 2. Have you maxed every tax-advantaged account available to you in 2026, including catch-up contributions if you are 50 or older? If the answer is no, that is your first move, always. 3. Do you have a 6 to 12-month cash buffer? If not, build it before either accelerating mortgage payoff or piling into investments. 4. Are you within 5 years of retirement? If yes, sequence of returns risk weighs heavier. The closer you get, the more the calculus tilts toward debt reduction. 5. Will you actually invest the difference, or will it get spent? Be brutally honest. Self-knowledge is part of the math. Here is the middle path most people miss. It is not all or nothing. A reasonable plan: make standard mortgage payments, max the tax advantage buckets, keep your cash buffer, invest the rest in a diversified portfolio, and revisit the payoff question every 2 or 3 years as rates, tax law, and your time horizon shift. The 2026 tax reset is your specific trigger to revisit it now. So back to where we started, U52. 18 years left, $500 a month sitting on the table. Throw it at principal, you sleep a little better, and you save some interest. Invest it instead, with discipline, and over 25 years that decision could be worth around $474,000. For a high earner with a long horizon, an itemizable mortgage, and the discipline to actually invest the difference. Paying off early loses on the after-tax math, and the 2026 SALT and deduction reset just widen that gap. This week, do 3 things. Pull last year's tax return and look at your Schedule A with 2026 SALT and mortgage interest deduction limits in mind. Pull your amortization schedule and find out where you are on the interest versus principal curve, and run the 5 questions against your actual numbers. This is general education, not personalized advice. Before you act on any of this, talk to a fee-only fiduciary financial advisor and a CPA who can model your specific brackets, time horizon, and behavior. Your situation, your numbers, not a generic spreadsheet. If this changed how you are thinking about your next extra payment, that little subscribe button is how I know which videos to make next. And if you are over 60 and you are starting to wonder what happens to all this if you actually sell the house, what the IRS will let you keep of your gain after 2026's rule changes, that is the next video on your screen right now. Most people over 60 assume the answer is simple. It is not. I will see you there.